Hello, I'm Carly Ebenstein, and this is Shop Talk. I'm continuing my conversation with Kevin Guttman, who is one of 218 certified experts in reverse mortgages. He's written a book that's a bestseller on Amazon. And today we're continuing our discussion, and I'm so happy that you're here, Kevin.
Thank you for having me back, Carly. It's great to see you.
Yes. So in our previous discussion, we talked about kind of the nuts and bolts and the basics of reverse mortgages. And we're going to link that up here so that if people want to backtrack and start from the beginning, they can do that easily. And so, continuing our discussion, one thing that I think some people would want to know about are if somebody has an existing home and maybe they have a jumbo or some kind of specialized loan, how is that treated if they're interested in a reverse mortgage?
Yeah, we do have we have two two main products, if you will. One is for homes under 1.2 million. That's the FHA version. The other is for properties over a million up to 10 million. And I have a little chart I can share. Maybe that will help see some of the
Sure.
differences. There's a lot of similarities, but there's also some differences. So let me see if I can find this. Um, by the way, people can get this on my website, reversemortgagerevolution.com, and they can see this consumer guide that they can download. And I want to make sure you can see that now.
Yes.
Okay, so this just compares. This is the left side is the home equity conversion mortgage. The right side is the jumbo. And I've highlighted the main differences. So one is the fees. The fees with a jumbo or proprietary reverse mortgage are lower because they don't have mortgage insurance. Remember last time we talked about the HECM, home equity conversion mortgage, which is the FHA version. Those come with mandatory mortgage insurance, 2%, which makes it a non-recourse loan. The
Hmm.
proprietary or jumbo reverse mortgages don't have mortgage insurance, so the fees are less. And that's what the next one says. The interest rate is higher with a jumbo because they don't have mortgage insurance. So right now, I'm sending out documents today to a client, and they have a $4 million property in California, and it's worth $4 million. And they want, of course, the jumbo because they get more equity, access to the equity. But the rate is 8.99 compared to a HECM, which is probably 6.5. But the fees are substantially less because of that, because of the no mortgage insurance.
Hmm.
The max loan amount somebody can get is $4 million. It's about 40% that they can borrow. Max value is $10 million. We can get exceptions if we go above $10 million, but that's kind of the general rule that lenders say they can go up to is $10 million. And then this is interesting too. You remember with the HECM, the age is 62. At least one borrower needs to be 62. With the jumbo, both parties need to be 55. So those are the few differences between the jumbo reverse mortgage and the HECM. What we see, Carly, is a lot of people on the coast, California, the Northeast, where the property values are higher. This is where we see them doing the jumbo proprietary reverse mortgages.
Interesting. Okay, that's good to know. Can you pull that chart up again?
Yeah, sorry. We'll find it again here. Here we go.
Great, thank you.
If I
So,
can make it bigger even.
okay, maybe a little bit bigger. Okay, so something here caught my eye. Here for loan purpose, I see refinance or purchase. And so I'm wondering if you can talk a little bit about reverse mortgages that someone might get in order to make another purchase.
Yeah, so this is an interesting way that people can use a reverse mortgage too. There's three ways. Most people use it to eliminate monthly payment. Some people use it to access equity. which might be these jumbo proprietary people. They've got equity sitting around not doing anything. They can tap into it and you have the velocity of money working for them, which is a term that financial planners like to use. But the third way is this reverse for purchase. So how that works is, let's say somebody's been living in their home for many years, but now it doesn't suit them for whatever reason. It's too big. Maybe they don't like the part of town they live in. Maybe there's possibly some deferred maintenance. Normally what we see is they have stairs, and one partner can no longer go up and down the stairs. And so some people say, well, I can't afford to move, right? But
Yeah.
what they can do is they can use a reverse mortgage. They make one large down payment, 65% down payment, and then they move to a home that better suits them in a stage of life, less maintenance, maybe less to take care of, maybe no stairs, maybe closer to family or whatever, better part of town they want to live in, etc. And now they have a home that's better in that stage of life, one down payment, no mortgage payment, and it's just a better living situation. And then there's an advanced strategy that we can talk about if you're interested as well, that I've had some of my clients do.
Advanced strategy. That kind of gets me very curious. Yes, let's hear the advanced strategy.
So I had a few couples last year come to me saying that they wanted to do the reverse for purchase and they wanted to overfund it. What that means is, so they're going to fund it beyond the 60 or 65% down. So this one couple in particular, they had a reverse mortgage, they sold it, they took the proceeds, they put all the proceeds down on their next home. So they only needed to put, I think it was 63% down, but they put like 80% down. Why would they do that? Because now they put 17% more down. Now they have this line of credit, because a reverse mortgage can come with a line of credit. And this line of credit grows by compound interest, tax-free, and of course proceeds from a mortgage aren't taxed because they're not income. It's a mortgage, it's a loan. Loans aren't taxed. So now they have this line of credit. I think it was like $102,000 if I remember. And so now this is growing by compound interest, 7% a year, and they were in their early 70s, didn't have long-term care insurance. This was their way to self-fund long-term care insurance. So now he was 72 and she was 70. This was last year. So they're thinking maybe in 10 years we might need some help, right? And we get into our 80s, we might need some more help around the house, bring somebody in to come cook or clean or help us get dressed or do errands or do whatever. It's harder as you get older. You need more help. So now they've got, if that interest rate stays at 7, for sake of example, we'll just say it does, the rule of 72, right? We know that that money's going to double over 10 years.
Yeah.
So now, instead of $102,000, they have $204,000. And now they can stay at their home. They can pay somebody to start coming in to help them a few times a week with cleaning, cooking, bathing, dressing, whatever they need, errands. And they've basically self-funded to pay for that care through their home equity, through this line of credit. And when they first got their very first reverse mortgage, I mentioned this idea to them. I said, there's a way to do this where you could overfund it. And they just weren't in the position to do it. And then when they ended up selling that house, moving to the next one, they said, hey, we wanted the overfunding strategy. And since, over the years, I've had several people take advantage. It's very unique that a lot of people don't understand that, you can actually have your equity working for you, growing by compound interest, and then you can use money however you want. The only restriction the government puts on you is you can't buy an annuity. That's the only thing they don't want you to do, because in essence, you're already unlocking and annuitizing your equity. They just don't want you to tie that money up for X number of years or fees or whatever. So that's the overfunding strategy, and for some people, it works really well.
So you kind of touched in my department, so I have to ask a question. They can't buy an annuity, but can they buy any other type of insurance?
Yeah, they can do anything except that. So what a lot of people do in your shoes is they are young enough and healthy enough where they still qualify for long-term care insurance. And you know better than I, but I believe there's a hybrid product or something where they can get a life policy with a long-term care rider or something like that.
Yes.
And
Yes.
so what I've had people do is they say, okay, I want to take, we'll just say it's $4,000 a year. I don't even know
Sure.
what the premium would be. We'll just make up a
Sure.
number.
Sure.
$4,000 a year for two people. They're not paying that out of pocket. They're not writing a check for that. They're taking money out of their equity or out of their line of credit, and they're paying for the long-term care insurance. So they're basically shifting the risk away from themselves, the exposure they have. I think Fidelity did a study, you may have seen it. Average 65-year-old healthy couple is going to spend $315,000 in out-of-pocket
Yeah.
medical expenses,
I saw that.
expenses.
Hmm.
So now they've shifted the risk away from their estate, away from themselves, onto the insurance company, and the home is paying for it.
Okay, one more question, and then I want to focus more on the reverse mortgages. But you're an expert, and this is my business, so I have a question. So if the person takes that money to fund some long-term care insurance, whether it's traditional or with life insurance, when they take that money to pay for it, is that money going to be taxed?
Good question. Any proceeds somebody takes, whether it's a cash out refinance from a traditional mortgage, whether it's a home equity line of credit, whether it's through a reverse mortgage, proceeds from a reverse mortgage, any mortgage proceeds are not taxed. The other thing sometimes people ask is, will this affect my government benefits? Because it is not income, it does not affect your government benefits. It doesn't affect VA, it doesn't affect Social Security, it doesn't affect disability. Occasionally we get somebody who's on Medicaid, it does not affect that because it's not income.
Interesting.
Now, we do coach people. Occasionally we do get somebody on Medicaid. We do coach them to say, look, just so you don't get in trouble with the state, keep the balance in your account under $2,000 so they don't question it, even though you can prove it's equity from a mortgage, it's not income. You know, you just don't want to go through extra work, so just keep it under $2,000 and you should be fine.
Wow. Okay. That's really interesting. Especially when, there are people who most likely will qualify for Medicaid, if not for a property, whatever it is. It's like, this is very creative. I also just want to backtrack for anyone who's watching this and also potentially interested in long-term care insurance. With what the arrangement that you are describing, that would give someone the ability to pay for the insurance with tax-free dollars, and then the long-term care benefits are received tax-free. So that is very compelling. And I'll just
It's
put
a
a,
double.
yeah, I'll just put a bookmark there. That's very compelling. I'm going to keep that in mind, and I'm sure anyone who's watching this should definitely keep that in mind. Um, so what about reverse mortgages that come with a line of credit? Can you talk a little bit more about that?
Yeah, I had a financial planner call me one time, and he said, I think I know the secret sauce of these reverse mortgages. I'm like, oh, good. What is it? And he goes, it's a line of credit. I said, you're absolutely right. It's the line of credit. And so for somebody with a lot of equity who, think about this, Carly, you have people that we'll just say a average house price of $500,000. And let's say they own their house outright. Good for them. About 40% of people own their houses outright, which is a lot of work and a lot of discipline. So I always commend people, if they've gotten to that point. But they didn't get there without leverage. Most people got a loan. Most people were strategic to pay forward or pay it off as fast as they could. But now they have $500,000 sitting there earning 0% return. I was doing a seminar at a senior expo, and I was getting ready to go up and talk, and this lady met me in the hallway right before I went up, and she said, I'm not coming to your seminar because I don't need to. I said, okay. She goes, I own my house outright. I said, well, congratulations. That's amazing. I said, so what's the return on investment on your equity? She thought for a second. I said, I don't mean the appreciation. We all get that. We all realize that when we sell or refinance. It's kind of a phantom number until we sell or refinance, right? I said, but that 500,000 that's sitting there, what's the ROI on that?
Mm-hmm.
She goes, I guess it's zero. She goes, you're right. I should come to your seminar. And so now what can happen is, let's just say somebody is 62 and their house is worth 500,000. So we know they can borrow about 35%, which is, I think, 167,
Yeah.
close to that. Okay, so now they may not need it, but they want to get it early because they want time working in their favor. They want that compound interest compounding year over year over year over year. So now when they're done working, we'll just say for the sake of example, they work 10 more years, now they're 72. Now that 167 has turned into 334. Now
Yeah.
it's doubled.
Mm-hmm.
Now let's just say they're really healthy and they don't need the money. They let it ride another 10 years. So now they have 668,000, they're 82,
Mm-hmm.
and they can use that money however they want, except buy an annuity. They can use it however they want. Maybe they want to help their grandkids or their kids buy a home. Maybe they want to help one of their kids or grandkids start a business. Maybe they want to do exotic or memorable family vacations. We talked about that last time.
Yeah.
Maybe they want to help their favorite charity or church or temple or synagogue, whatever. The bottom line is now they have this big, huge chunk of money that's sitting there that they can distribute or disperse however they see fit.
Yeah.
So the reverse mortgage line of credit is really, it really is the secret sauce of helping somebody strategically use the money and however they choose to while they're still here. Last time we talked about giving with a warm hand or a cold hand, right? So this is a way that they can do it while they're still here and see the impact that it can have.
This is such great information. You continue to educate me, and now I'm actually thinking about this a little bit differently in a good way, just realizing how there is a possibility to actually purchase long-term care insurance with tax-free dollars and then also receive the benefits tax-free. Um, Love it.
That's pretty cool, isn't it?
It's very cool. So let's put a bookmark on this and make another date to come back and continue this conversation, because I feel like there's still more to learn from you, Kevin.
One thing I'll mention, if people want to learn more, they can go to my website, and I'll pull it up here. It's reversemortgagerevolution.com, and it has so many great resources. People may want to download this consumer guide right here. They
Mm-hmm.
put in their name and their email, and they can get a consumer guide. It compares traditional mortgages with reverse mortgages, talks about HELOC versus reverse mortgage line of credit, compares the jumbo with the HECM. There's an FAQ section that exposes and dispels some of the myths that people believe about reverse mortgages. But it's just really a great, this for sure. I mean, they can go through the whole website if they want. There's all kinds of stuff in here, articles and videos and blogs
Right.
and interviews and everything. But this guide in particular might be the most helpful for people.
Right, right. Well, and I appreciate how, even though you're based in Colorado, but you're licensed in many other states in the country. So that's really good news.
Well, thank you for having me back, and I look forward to our next time.
Yes. Thank you, Kevin.